Hello and welcome to the Strategy of the Week tutorial for 28th of February 2014. My name is Steve Chappell, the Director of Educational Services here at VectorVest. Well, now that you've seen the timing portion of our presentation for this weekend, you would have noticed that we're starting to receive some preliminary indications that the market is beginning to change course. With that in mind, we wanted to present an important topic on 10 tips to maximize profits and minimize losses. So let's move right into tip number one. Tip number one is if price crosses below its 40-day MA or moving average, that's an excellent early warning signal. So from here, we'll take a look at a few stocks. I've moved us right over to the home page for VectorVest 7 Australia. And to access the stocks, we simply go right up to the top, click on Viewers, and we'll begin tonight's presentation right in Stock Viewer. Now to really hit the message home, I've got a few stocks in mind that are heavily traded S&P ASX 200 caliber stocks. First one we'll take a look at is BLY. Here we have BLY. So the first thing I want to do is just open up a stock graph. Easy way to do that, just simply right click on the stock and move right on down to View Stock Graph. Well, they do say a picture is worth 1,000 words, and here we have a stock that has really been suffering over the last year or so. The first thing that I want to point out is by default in our normal default charting package, you should have a 40-day moving average listed on the screen for you every time you open up a stock graph. If you have moved around and created some of your own templates, you can get right back to our default layout by clicking on the graph layout section and going to the VectorVest layout. So let's take a little peek at the 40-day moving average and how important, of course, it can be. So from here, I'm just going to scroll back a bit, and we'll see that we had a stock that was a buy recommendation. As it began to roll over and head down towards the moving average, of course, it moved into a hold recommendation and eventually hit a sell. But we said the 40-day moving average can be an excellent early warning signal. So here you can see price crossed below the 40-day moving average well in advance of receiving that sell recommendation. Generally speaking, and you can see clearly by the curve of the stock, it's unwise to be holding assets long when price is below that 40-day average. You can see that it stayed well below the 40-day average as it took a horrific fall all the way down to around 50 cents a share before it started to capitulate above and below that average. This is also a warning sign. If you have a stock who's just, one week it's above the average, next week it's below, typically that means there's no trend in the stock whatsoever. So as the stock began to pick up and perform okay, it began to receive a few buy recommendations, and of course there was an opportunity to make some profit there. But as the stock has broken down again more recently, it's again very wise to heed that 40-day MA as an excellent early warning. If nothing else, it's a heads up to tighten stops, things of that nature, and protect profits that you may have, or mitigate losses. Just as another example, I could click on Add New at the top, and we could do a second graph on a different tab. Let's do ALQ, or ALS Limited. Here again, we could see we had a stock that was a buy, began to break down, fall below that 40-day moving average, well in advance of the sell signal, before the stock went on a sufficient fall in the market. Here again, we see a stock that's struggling to stay above that moving average. Again, a warning sign on entering any positions during that time. Once it started to perform, eventually it received that buy recommendation. There was plenty of opportunity to get some profit in there before it began to break down yet again. So hopefully these two stock graphs will drive that point home for you. Let's jump right back into the PowerPoint and take a look at tip number 2. So here we go. If RT crosses below 1, that tells you the stock price is now certainly in a downtrend. Let's jump right back into the graphs. So here again, if we start on the left-hand edge of the screen, when RT crosses below 1, that would be further confirmation that the stock is now in a downtrend. In this case, it did occur before the sell recommendation was even reached. So we've had a couple of warning signs in advance of that sell signal. So if we move over and take a look, again the stock performed pretty well. As it began to break down, RT would have added some further confirmation to that moving average breakdown just a little bit later on, and very shortly after received that sell signal once again. or recommendation. We can see those again up at the top, across the top of the graph. And I have those added on by adding the recommendation or clicking on the recommendation button below. If we move back over to BLY, we begin to flirt with crossing below as early as 21st of February 13, with that RT really starting to head south and move below 1 on the 0 to 2 scale. And again, you can see as the stock really was performing horrifically, the RT still stayed well below 1. We received some beautiful sell signals to mitigate a tremendous amount of the loss that we could have incurred in the stock. And of course we can again see that occurring on a recent basis. So let's move right into tip number 3. If the recommendation is turned to sell, ignore it at your own risk. So let's go right back to the graph. And here again, when we say ignore a sell signal at your own risk, look here as the stock received a sell signal, and at that stage the stock price was still at $1.68 a share. We did not receive a buy recommendation whatsoever until the stock got all the way down to 47 cents a share. So that is quite a fall in share price. And yet again, we've received another sell signal on a current basis at 36 cents a share. So just following the sell recommendations can save you a bundle of money. If we take another quick look at ALQ, again we would have received a first sell signal after a little bit of a run on 14th of March. Share price at that time was $10 and we'll call it 34 cents on the close. And we can see that the stock price went all the way down, hit a low here of $8.61 before it started moving up again. We had a little bit of opportunity to profit on the stock, and again would have really needed to mitigate a lot of this loss that's going to occur when the share price came down to $9.17. And of course right now, as of the close today, it's at $7.59. So again, very effective sell recommendation on a stock. So let's move right back into our tips. Tip number 4 is if the price crosses below a trend line, consider selling. You can adjust trend lines up, but never adjust them lower. Of course, we're talking about long positions in this case. So let's jump right back into the stock graphs. Here's where I want to go ahead and add another symbol just to get a beautiful idea on how this really works. And we're going to pick out a very familiar share, Telstra. Here you can see with Telstra, it has a lot of volatility. And so you're going to see it running through that 40-day moving average a ton, even though the general direction is up. So in a case like that, you may want to move to something other than the moving average that we were pointing out earlier. So I'd take off the MA, come right up to our drawing features, and here I would use what's called the extended line. When I click on extended line, I can connect a series of lows. And now the nice thing is, as data comes in, as I come back to this stock chart next week, this line will still be extending out, incorporating the latest data. Whereas if I just drew a normal line, it would only connect up through the 2 points that I select. But here you can see on a current basis, Telstra is retesting that same area where we drew off the first 2 pivots. It pivoted a third time, making it an even more substantial trend line, and it potentially could pivot here again. However, if the stock price continued to head lower than this current trend line, that would be an opportunity to protect profits on Telstra. Alright, so let's move on to our next tip. Never give back more than half your profits. Well, let's do a quick example on that one. For this example, I'm going to go ahead and clear the Find in Stock Viewer. I'm going to go back. We're going to go back to, say, July of 2013. Reason for that is we received a beautiful confirmed up call on 12th of July. That would have been a great opportunity to buy some of the best stocks available, and those best shares are found right at the top of Stock Viewer each and every single day. Had we purchased, say, the top 10 positions and held them to current time, just as a quick example, we can do what's called a quick test. And we're going to quick test the top 10. And we'll test them all the way up to current. And you can see, boy, nice returns on these particular shares. GBT is up 68%, FMP 56%, ALU 32%, DLS 28%. Had you gone through and used the Midas Touch, probably could have done even better with some of these stock selections. But the point being on this slide, if we're up 68% in a share, why on earth would you ever want to give back more than 34% of that? In fact, that may be a little steep. As a general rule, and a rule that's really helped me with my trading, never give back more than half of what you made. And of course, we really only begin to apply that technique once you get about a 10% gain in an individual share. Otherwise, you're better off with some of the other tips that we've already explained. So from here, we'll move into our next tip. Tip number 6 is never ignore a confirmed down signal. To illustrate this, I want to go back into a market timing graph like we showed you earlier in the timing presentation this evening. To get there, I'm going to go right up to the Graphs tab, change it from stock to market timing, and in this case, I'm going to look at a 5-year period. We're going to take off everything except for price at this stage. And I just want to throw on the confirmed signals. One of the things you want to get accustomed to is never ignoring a confirmed down, because you don't know when the next big downturn is coming. For example, if this is looking at the average of the Australian share market, the average stock, let's call it, wouldn't it have made a lot of sense to be out of the market as the market hit this substantial fall? How about this next one? Or the next one? Even this little fall here may not look like much, but that's several months in time where the stock market was not performing well at all. It makes an awful lot of sense to preserve the profits you have from the prior rallies, and that way you're not in recovery mode when all the new upturns come into play. What can drive investors nuts sometimes is when we receive these little whipsaws, as it's referred to in the industry, where you get a signal one week and then seems like the very next week the signal changes and reverses. So hopefully you've picked up it's not wise to ignore them regardless of that action, because again, you don't know when the next big one is coming. So what I would encourage investors to learn is stock options, because they can provide you insurance against a potential big fall in the market and still give you some upside profitability with your individual stock positions. So let's take a quick look at the next tip. So with tip number 7, sell a covered call. Folks, there's very little you can do wrong. In fact, I would say there's 0 you can do wrong with selling a covered call. At minimum, you're going to receive what's called a premium, or some income on the position that you're already trading. So if you've already got a gain, a substantial gain in a stock, it's going to give you a little bit more. And in a worst case scenario, if a stock continues to fall, at least you got some premium to offset that fall. So let's quickly discuss the covered call option trade. When you sell a call option while owning the stock, you are writing a covered call. If the stock price rises, you may be forced to sell the stock at the strike price, known as being called away. If the stock price continues to drop, you can sell calls against the stock position over and over again. Your losses on the stock position will be at least partially offset by the premiums you will put in your pocket. So, as a quick example, if you own a stock at $28 and you sell a $30 option, you are selling someone the right to call that stock away from you at $30. But in exchange for that, you receive what's called a premium that you put in your pocket. Could be $1 or $2, just depends on the individual share and the expirations and so forth that you select. But at minimum, you're padding your income with that extra $1, $2 a share. And you still have all the upside potential in the stock position from $28 to $30. So in the case of receiving $1, you would get $2 in upside to the strike price of $30 from 28, and you'd receive the extra $1 of premium. So even if it's called away, you make the most you can make in the trade, and it's a win-win situation. Let's move on to our next tip. Tip number 8, buy a put option. If you own a stock, you profit when the stock price rises. If you own a put option, you profit if the stock price drops. So if you buy a put option while also owning the stock, you're basically buying an insurance policy. If the stock drops, the put will rise in value, offsetting some of your loss on the stock. If the stock rises, the put will decrease in value, perhaps expiring worthless, just as an insurance policy is designed to do. Of course, you must take money out of your pocket to pay the premium for the insurance. So in the same case of a $28 stock, if we wanted to go out and buy, say, a $25 put option, again, in this case, we're going to have to pay the premium or outlay some cash. And in this case, let's say it's $1 cost on the premium. Once the stock price begins to fall, the put option is going to gain value. And remember, we had to pay that $1, so really our losses will be offset 1-to-1 once the stock price falls below $24 a share. That's assuming that you have the same number of shares controlled by your option contracts as you have in your long stock position. Now, should the stock price never fall below $25, that insurance policy is going to expire worthless. But at least you had the peace of mind knowing once the stock price falls so far, my losses are completely offset. So let's move on to the next tip. Tip number 9 is to combine the two together. You see, put options can be expensive, so we can combine the sale of a call with the purchase of the put. It says here it's a terrific way to finance your insurance policy. It's to do both those methods. This is more commonly known as the collar. We outline this technique in some detail on 2nd of August 2013 Strategy of the Week presentation, Protect Thy Capital. But I want to spend a little bit of time with it again here today. So I'm going to move right back over into VectorVest. And what I'm going to do now is just move right into the Viewers tab. I'm going to go down to the S&P ASX 200 watch list. And we're just going to take a look at the very first optionable stock that's got some value to it. That's going to be Seek Limited. Oh boy, I hope some of you have had the pleasure of owning this little company, as it's had a terrific explosion lately. Now let's assume that we are beginning to hit some turbulence. One of the things that we could do is collar the stock and not have to go ahead and sell it and take the profit. So from here, what I can do is right click, and if I've purchased an add-on module from VectorVest called Options Analyzer, that will appear on my right click menu. I can go to Analyze Options. I can go to Bearish, Collar. So that's going to load Seek right in for us. Here we can see that when we're looking at the option, the stock price is $17.11. We're currently looking at a $17 strike on the short call, and what loaded automatically is a 16.5 put. As I scroll across here just a bit, in exchange for the default setup here, I would receive 62 cents in premium from the short call, and I would only have to outlay 26 cents in premium for the long put or the insurance policy. So here's a great example where the income from the short call is more than financing the purchase of the long put. In that case, I can see that with this particular trade, I would be, in exchange for placing this collar option, receiving a maximum profit potential of $260 while only risking $250. Now this is assuming that we did 10 contracts. Each contract controls 100 shares. So if I owned more shares of stock than that, I would have to ramp up the option contracts, which would give me even more profit potential, but also even more loss potential. The good news is it's offset. So here I could see my break even on the stock would be at $16.75. Once we got down to $16.50, I could incur no further loss on this particular position because I'm covered by the insurance policy of the put. Should the stock price start to rise and actually really just kind of stay where it is right now in this particular setup, I'm right up there at maximum profit, and I would at least keep the difference in the premiums that we incurred for placing the trade. So while the options market in Australia can be thin at times, sometimes that can provide an advantage vis-a-vis cheap insurance, even cheaper than we can get here in the States. But of course, options, many of you will be placing the option trades on US equities, and I know many of you do that. And so the concept is still the same, and this is a wonderful way to mitigate losses on stocks that have had a tremendous run in times of uncertainty. Let's jump right back into the PowerPoint for our final tip. Sell the share outright. There's no surer way to maximize profits than locking in the gain, because inevitably you don't have a gain until you do so. So I want to thank you for tuning in to this week's Strategy of the Week presentation, and we'll see you again next week right here at VectorVest University.